Hello. How may I assist you today? Dalbar's Quantitative Analysis of Investor Behavior Report is an annual study that has consistently found a significant gap between the average returns earned by individual investors and the broader market. According to their research, the average investor tends to underperform the market by a significant margin over long periods of time. Over the past 20 years, the investors in the Dalbar study earned a net return that was 2% per year lower than if they never made a single change to their account over those 20 years. Investor behavior often results in poor investment returns relative to a blind squirrel throwing darts and randomly picking investments for several reasons. 1. Market timing. Short-term market swings and media news events lead many investors to frequently buy high and sell low. 2. Overconfidence. Investors may believe they have more knowledge or skill than they actually do and may make investment decisions based on intuition or feelings, rather than objective data. 3. Herd mentality. Investors may be influenced by the behavior of other investors or the media. 4. Emotional biases. Emotions such as fear, greed, or regret may lead to impulsive or irrational investment decisions. The combination of these factors can lead to poor investment returns compared to a properly diversified investment approach, which does not rely on market timing or emotional biases.
So ChatGPT is the talk of the business world. It's being discussed on a range of earnings calls globally with tech giants, with energy companies, even with Wall Street banks, and for good reason. It was launched on November 30th of last year, and the chatbot brought in 1 million users within its first 5 days. Now fast forward 2 months later to January 30th of this year, and ChatGPT has amassed over 100 million users, making it the fastest growing consumer application in history. Now to put that into perspective, it took TikTok 9 months to reach 100 million users. It took Instagram 2.5 years to reach that mark. So ChatGPT is the talk of the town, as they say, but is there more to it than just media hype? The artificial intelligence bulls firmly believe that this is Silicon Valley's next big thing. They're saying that AI's reached that tipping point where it should now enter the mainstream, and some forecasters are even saying that it may be the next industrial revolution that will absolutely change the way in which we all work. On the other side, we have the bears, the skeptics, who think that it's overtalked and it's overhyped, and perhaps rightly so. They're reminding us that it was only a few years ago that the media was pushing virtual reality and the idea that we might all be working in the metaverse together. If we go down that internet rabbit hole even further, there are even some that are saying that AI has reached that true intelligence point where maybe the likes of Skynet will descend on us and might take over the world, like in the Terminator or the Matrix or other futuristic movies of our collective youth. Now with the media, it's really hard to tell because they're looking to attract eyeballs, and their motivation is click ad revenue over top of, let's say, delivering us knowledge and intelligence. It's hard to tell whether something is truly investable or whether it's just media hype. It was only just a short while ago that marijuana or crypto was something that was getting pushed, and we all know how badly that has ended for some investors. Our goal this evening is to see if we might be able to bring a little bit of perspective beyond media hype stories to what's going on in the economy and what the investment landscape might look like in the year ahead. Good evening, everybody. For those of you who I have not yet met, my name is David Sung. I'm the president of Nicola Wealth, and it gives me great pleasure to welcome all of you to Finding Alpha, Nicola Wealth's 2023 Strategic Outlook. Now, it has been just about 3 years since many of you were here in this room with us for our last Outlook, and I have to say, it feels great to be back here and in person. Our previous Outlook presentations have often featured our Chief Investment Officer, Rob Adel, and unfortunately, Rob will not be with us this evening, as Rob and his spouse, Karen, are unfortunately away dealing with a family illness, and they are in our thoughts this evening. But presenting alongside myself and John this evening, it's kind of going to be like speed dating. We have Mark Hanna, our director of our real estate division. We have Bijal Patel, our CFO and head of our private capital group. We also have Ben Jang, one of our portfolio managers within our public assets team. And collectively, they'll each be speaking on their respective asset class areas and what their view is in those areas for the year ahead. Over the past 3 years, we have seen a lot of change and certainly a lot of volatility, especially both with global affairs and in the public markets. Now, fortunately for us at Nicola Wealth, change has meant growth. Over the past 3 years, we've more than doubled our headcount to 450 people. We've expanded to new regions in Victoria and Calgary, and we've started 3 new offices in the Greater Toronto Area. Investor Economics presently ranks Nicola Wealth as the #1 fastest growing private investment counsel firm in Canada. Another change that we're really excited about is an expanded focus in working with charities and foundations and Indigenous communities and family offices. And we've established a specific team who are solely focused in this particular area. So if any of you happen to be involved with or perhaps sit on foundation boards, we hope that tonight's presentation might be a reason for those boards to consider having a conversation with us. Now, over the past 3 years, we've more than doubled client assets. They've gone from $7 billion to $13.4 billion. And we're very fortunate to say that we serve over 4,000 individuals and families and institutions across Canada. And one of the reasons for the growth in assets is returns. And let's talk about returns for 2022 and call it for what it is for the public markets. It was a terrible year in the public markets. Against the backdrop of a Russian invasion, against rapidly rising inflation and interest rates, the public markets took a beating last year. Look at the bar in the middle. That's Canada. We'll call the Canadian stock market the best of the worst, down minus 5.7%. The US market down minus 18%. The technology index down over minus 30. And that last purple bar on the right, that's supposed to be the conservative portion of an investor's portfolio. Bonds and fixed income were down over minus 11%. Now, our other speakers this evening will review why our all-weather Nicola core portfolio was up over 7.5% last year. And I look forward to hearing about that. But it's really hard when I look out into the year ahead, I see nothing but uncertainty. And the reason that I say that is that's all the media keeps showing me. As investors, it's hard for us to get a sense of the direction we should be going in when even the world's largest financial institutions seemingly can't agree on what the year ahead looks like. Let's look at what we'll call the bears, Barclays, Capital, and Fidelity. Barclays looks at the year ahead and says that this could be the worst economic growth year over the past 40 years. Fidelity says it looks like that a hard economic landing is unavoidable. Whereas on the other side of the equation, we'll have what we call the bulls. Goldman Sachs, JP Morgan, UBS, they all believe that 2023 is full of opportunity and big gains to be had. So what do you choose? Fear or greed? Are you like Barclays and you have a little bit of uncertainty, so you decide, I'm going to sell my portfolio to cash and sit on the sidelines? Or are you more like Goldman Sachs and you're quite bullish and excited and you decide to double down and go extra long public equities? When we are faced with fear and greed, and as ChatGPT pointed out, referencing the Dalbar study at the beginning, when investors are in the face of volatility, we make decisions that are not in our own best financial interest. And that is why, over the past 20+ years, we've followed an approach that is also practiced by the world's largest institutional pensions and sovereign wealth funds. It's an approach that sees us take a large portion of our asset allocation and steer that away from the volatility of the public markets and instead into the ownership of institutional grade real estate, into the ownership of profitable private businesses, private debt, mortgages, infrastructure, and other private assets. It's an approach that has allowed our Nicola Core Composite Index, made up of actual client results, to outperform a 60-40 public equity and fixed income benchmark by over 3% compounded on an annualized basis. And that's before we should take off another 2% from the index due to bad investor behavior. Now, lastly, because we know that true wealth management is certainly more than investor returns. In fact, it's our view that because each of us is unique, everything should start with financial planning. And because planning is an ongoing process, and because our lives are always constantly changing and dynamic, and as we move through our personal financial journeys, it's why our advisors at Nicola Wealth work very closely with our clients to constantly review the items that you see here on the financial planning wheel, which need to be looked at and reviewed on an ongoing basis. At Nicola, we set a standard for ourselves of pursuing going beyond in everything that we do. We work with our clients to achieve their aspirations beyond wealth. Our purpose is to share our expertise and best skills and to help you achieve the goals and the legacies that matter. With that, please allow me to welcome to the stage my partner, our chairman, our CEO, John Nicola.
Thank you, David. So this is what speed dating's like, okay? I'd like to say I can see you all, but I can't see any of you. And in fact, I was just thinking what David was saying. It's been 3 years, and I thought, yeah, 3 years, like, I don't know, like I'm almost feeling a little nervous here. It's like, is this coming back on stage and speaking to people like falling off a bike or falling out of a plane without a parachute? I'm not, we'll find out by the time we're finished here. I was trying to get ready for tonight, and I thought I'd try on a suit. I don't know about a lot of you, but I haven't tried to wear a suit for about 3 years either. And I was, had my shirt on, and I'm trying to tie my tie. Now that took about 15 to 20 minutes. So finally my wife comes up to the bedroom and says, "What are you doing? You're going to be late." I said, "I'm tying my tie." She says, "You look more like a drunken sailor trying to tie the shoelaces." So, and then I find out that my colleagues here, they don't have to put up with that because they didn't try to put on a tie in the first place. So obviously I didn't get the memo. All right, so let's talk about where we're going with this. I want to focus on, this is the framework for taking a look at some macro issues, essentially trying to make sure we see the forest for the trees, at the same time taking a look at other factors that will affect how portfolios should be built. How do we, as an organization, take a look at the three main areas that we invest for clients in real estate, in fixed income, and public and private equity? And as David referred to, what do the planning tools look like that we have developed that will make a difference in how people accumulate wealth, but more importantly, maybe, how they decide to give it away? So let's talk about this. This is a newsletter we put together just recently this year called See the Forest for the Trees. And as David obviously commented on, obviously equity markets were down. And as he mentioned, so were fixed income markets. In fact, arguably, fixed income markets were worse across the globe than equity markets were. And if we take a look at the impact of rising interest rates, what we see is essentially that we have a portfolio here where essentially the returns, David mentioned, were really strong for our clients, 7.5% last year. Balanced portfolios were the worst they'd been since 2008. how do we actually arrive at this outcome? And what will we do this year in particular to see if we can continue that streak? So let's look at 2023. Is it glass half full, glass half empty? Well, in theory, happy days are here again. We can find out all of these reasons. The S&P TSX is up 4% year to date in less than 2 months. COVID lockdowns have ended in China. Sanctions make a big difference in the Ukraine war. Short-term interest rates probably are at or near their peak, and inflation likely has peaked as well. So there's the glass half full. And in addition to that, we're getting incredible news on the employment front. 500,000 new jobs in the US last month, and an unemployment rate that's now dropped to 3.4%, the lowest, I believe, 2006, 2007. Canada, arguably easily holding in this front, 150,000 jobs last month, and an unemployment rate that's gone from 13% to about 5% in a period of 3 years. So you have to look at this and say the glass is half full. Now, one of my favorite characters from Winnie the Pooh, I don't currently read Winnie the Pooh, just in case you're interested, but I used to read it to my children when they were younger, was Eeyore. And Eeyore, of course, was always depressed, had a cloud over his head, but had these great sayings. And this is one of them. If I close my eyes, will the mess disappear? Well, let's consider what it looks like when you look at this from a slightly different point of view. The recent rally in stocks is at a dead cat bounce. Basically, equities are already down 5% from the mini peak they created at the end of January. US allies are in a giant tech war with China. Ukraine war could last easily for the rest of this year. Interest rates, therefore, could remain high for all of 2023. Inflation could remain elevated for an extended period of time. That job report is going to cause central banks to keep interest rates higher for longer than anybody expects. That unemployment situation has to reverse itself before central banks are going to change their tune. We're also in an inverted yield curve, and I'll explain that in a minute. And when we're looking at it, these are recessions. These gray bars that you see on this graph are recessions over the last 40 years, and every one of them was preceded by an inverted yield curve. So what is that? Well, it looks like this. This graph explains the difference between 2-year government bonds in the US and 10-year government bonds. Now you notice here that this is the zero line. If you think about it, if the government wants me to lend them money for 10 years, I would expect a higher interest rate than if I only have to lend it to them for 2 years. When a yield curve like this inverts, so right now, if you want to buy 2-year government bonds in the US, you get 0.8% higher interest than if you lend the money to them for 10 years. You get a higher interest rate on 2-year bonds than if you lend it to them for 30 years. And that's an inverted yield. And every time this has occurred, we've had a recession. And the expectation for Morgan Stanley, for example, is exactly the same thing. So their outcome is to say a recession is inevitable. How deep, how long, when it will occur, that's the unknown. So coming back to our forest that we can see, we're looking at 5 areas that we think are going to be a significant issue for the medium to longer term, as opposed to, let's say, for just this year alone, including demographics, including supply chain issues, interest rates, reshoring, which we'll get into and explain in a minute, and climate change. But there are other issues that are maybe a bit more immediate. When we take a look at aging, for example, almost 50% of the countries in the world, representing 50% of the population and 70% of GDP, have declining birth rates. Is that going to be inflationary, aging populations, or deflationary? And what's the impact on capital markets? Where's the money coming from for new investments? For interest rates, we've had a 40-year bull market in interest rates since 1981, and it ended in 2021, not to be repeated again. We have the highest interest rates on short-term interest rates that we've had since 2007. Inflation is a dependent factor in terms of where those interest rates are going and where are we going from here. With respect to supply chain, the geopolitical issues are significant in affecting that. The Ukraine war in particular. China has a conflict with US. There's a COVID strategy. The real estate bubble and demographics are all significant issues for China. We'll take a quick look at those as well. And the reliability of shipping and manufacturing. So there's a great book by Peter Zeihan called The End of the World is Just Beginning, and it talks about the deglobalization of the world. Now, the world has been going on a globalization stream basically since World War II. So we're talking about a 75-year period of time when global trade and globalization continued to increase. And that turned roughly in the last year. And the real question is it going to continue to shrink and stop and reduce? And that's a reasonable, credible outcome to expect. And reshoring is the extension of that. So you bring the supply chains closer to home. Basically, you reduce shipping costs, you use the safety of technology and the rule of law in terms of the environment that you're working in. And then finally, there's wage differentials. It may surprise you to realize that a large part of the Western Hemisphere has much lower labor rates, for example, in China. All right, let's take a look here at the last item, climate change. So this is a technology issue as much as it is a climate issue. The challenges are going to be with solar and wind are going to be related to battery storage. Nuclear is in play, fusion possibly within the next 5 to 10 years. Canada may be a winner in terms of the impact of climate change as well, for a longer growing season. And fossil fuels will decline, but they will persist and be a significant part economically for, I would suggest, decades. So let's look at the geopolitical issues, okay? We have that, inflation and recession as additional factors for this year in particular. So what's the impact on your asset allocation going to look like? Let's look at the aging issue. This is a chart from Harry Dent. These are US numbers. Notice that the spending issues related to aging peak roughly between 45 and 50. And by the time you get to 60, your spending requirements are actually significantly lower. My view on this is that an aging population actually is functionally a deflationary factor. And the proof in my mind are countries like Germany and Japan, and we will soon see China as well. So the Chinese population just recently decreased by about 800,000 people in theory for the first time, well, I guess in the last 60 years since the Great Famine. And some people argue that the population has been declining for quite a while before that, but these are our official statistics. When we take a look at this particular graph, back in 2012, the working age population was about 1 billion people in China. And in the last 10 years, it's already dropped by 18 million people. And the birth rate in China is now down to 1.16, which is barely half of what the replacement rate that's required is. On top of that, the Communist Party has made a decision that in order to create growth, they basically suppress consumer spending. So consumers in China get a much smaller percentage of the pie than virtually in any other country, certainly in any other Western country in the world. And that means essentially that there is no relief coming in terms of Chinese growth that's going to be significant from the consumer sector. It's all based on exports and infrastructure. So these are a number of countries, and there's China at the bottom. And this graph is a slightly different percentage, but basically 50% of the Chinese GDP is consumer-oriented, and this is where they have to be. But if they get to this point, it means that the CCP is giving up more and more control in terms of its citizens and their wealth, something they're unlikely to want to do. So if they can create growth by building infrastructure, for example, 60 million empty apartment buildings, or bridges or roads to nowhere, or any other number of things, they will, and they are doing that. And if they can generate more GDP growth by selling things to other countries, they will. But if the world's deglobalizing, then that will have a long-term impact on the trade approach, and the infrastructure approach won't continue to work. You can grow an economy by spending money on infrastructure, provided that the infrastructure generates a return for the population. But if you build a high-speed train to a city of 5 million people that actually has virtually nobody living there, then that by itself produces nothing of any consequence. And when we take a look at labor costs, for example, these are the facts. Mexico has had lower labor costs for almost a decade than China. And now the reshoring issue starts to make sense. If you think about energy costs, transportation costs, a connection and the friendly relationship they have with the US, let's say, compared to China, this it seems to be inevitable. And one last thing, one of the challenges is China's had one of the fastest growing economies in the world for the last 30 years. And it's reasonable to assume that in that environment, investing in that environment, you would get a great rate of return, at least a decent rate of return. According to strategists, this is the rate of return for the MSCI index in China for the last 30 years, 1.2% a year, compared to 9.7% a year for the S&P 500. So the two things are not connected at all. Let's take a look at interest rates. The rates will continue to rise, maybe not so much in Canada, but in the US, at least for a while. Negative impact virtually on every asset class as a result of higher interest rates. And how far before the bear market in bonds ends? Because it's not over yet. And what's the impact on housing in Canada? Well, you see the headlines, both, especially in Toronto and Vancouver, prices down 45, 49%, or not prices, volumes down 45 to 49%, and price drops that could be 15% from the peak by mid-2023. And when I wrote this originally, I thought, okay, that's, it's a pretty big drop, and I think it's going to be larger than this now. But the saving grace over the intermediate term is immigration. If the Liberals' immigration policy stands, there'll be a need for 500,000 new homes in Canada in the next 3 years. Most of that growth in homes will occur in Toronto and in Vancouver. In the US, up until November of this last year, prices dropped 12% across the US and very similar in Canada. So if we look at it and say they're already down 12%, and we haven't yet seen interest rates turn, I'm not sure 15% is going to be where the final number is. Everybody's talking about a recession coming. It makes you wonder because you can't really read any article where it doesn't say a recession's coming. Or it's a relatively effective way to deal with inflation. If successful, a rate hikes will stop, and the opportunity to acquire longer duration bonds and equities will occur at some point. I wouldn't suggest that point is now. From a geopolitical perspective, in Russia and the war with Ukraine, we have impact on commodity inflation. Russia is already a pariah state, a nuclear threat. It's demographically imploding worse than China. Their oil and gas revenues are already down $150 million US a day because of sanctions. Their deficit last year was $47 billion. In January alone, it was $25 billion for a single month. And you have to remember, Russia has a GDP 10% lower than Canada. So these are really big numbers. For China, the issues are trade war and tech, the world's largest housing bubble, debt issuance and defaults, very fast-growing debt, especially from a government perspective, much lower future economic growth, the rule of law, demographics, these are all considerations for China. From our perspective, we think it's not investable. So let's look at climate change. The map you're looking at, all of the lovely colors, the green areas represent countries that would benefit from longer growing season, lower energy usage. Canada is in that list. Russia is in that list in a big way. If you're in the orange sections, you're kind of neutral, and if you're starting to be dark orange or red, you're in some serious trouble. The other thing to take a look at is where, these are two different oil companies, BP and Chevron. Which oil companies are having the greatest impact on reduced carbon renewable energy? So when you take a look at investments and you want to do something that's environmentally friendly, there is a little complexity to that because there are a number of, quote, oil companies that are becoming real energy companies and converting their thinking in terms of what they're doing in terms of the impact, the carbon footprint that they generate. So some of these companies have a bigger impact on reducing carbon footprint than many, many other organizations that are pure play renewable energy. David talked about the concept we have about beyond stocks and bonds, and when you go to our website, you'll see this. So when we look at this, we think the whole is greater than the sum of the parts. So when we take a look at our strategy, we say, that's the whole. That is the asset allocation. But it's not good enough in its own right. We need the parts, the tactical side. We have to execute well in each asset class. And my colleagues will come up in a few minutes and they'll explain exactly what they're doing in that regard. But I thought it might be fun to take a look at something related to 60-40. So just imagine, this is you can't read this chart, trust me. I've tried even with a microscope. But I put it in here anyway because this is the Morningstar Neutral Balance portfolio. This is a 60-40 portfolio. And their returns for the last 5 years, and they're not great. I thought, what would it be, how would they compare to just a 60-40 portfolio without real estate, just basically private equity and fixed income, but all private, 60% in our private equity fund, 20% in our mortgage pools, 20% in private debt. The difference in returns for the last 5 years are that the public 60-40 version generated about a 3.9% rate of return against a 10% return for the private side of things. So if you're wondering why we spend a great deal of time and focus on certain kinds of assets that are not available in public markets, this is part of the reason. We do have a significant amount of capital in public markets, and we have to be sure tactically we're performing there. So we took a look at all of our public pools last year, 7 equity, 3 fixed income, and 1 balanced. We took a look at the returns compared to Morningstar, and we took a look at year-to-date returns in 2022 and 3 and 5 years. There are 32 possible data points out of all of these funds. In 31 of them, we were able to be in the first or second quartile in performance. And in 25 of them, we were in the first quartile performance. So again, execution in each asset category is critical. On real estate, Mark's going to come up and talk a lot about what they're doing in that area. I just want to show you one particular graph. The longest fund we have in real estate has been our Canadian Real Estate Fund. It was created in 2005, not quite 18 years old, and this is a comparison between its performance and the TSX REIT index over the last 17 and a half years. And what you can see is that the returns, on average, are 3.1% a year more after fees, and the volatility is literally 82% lower than it would have been had we chosen to invest our clients' money in REITs in Canada. I'm going to recommend this for any of you that really like to, dive deeper in this kind of thinking. Howard Marks is a brilliant investor, runs Oaktree, was a founder of Oaktree. They do a lot of private debt, and he's had a great track record for 50 years. He wrote a memo called Sea Change. If you want to reach us, we can certainly send you a copy of it. But if you simply Google Howard Marks and Sea Change, you'll get this memo. In it, he talks about secular changes that occurred in his career. The first was the massive inflation of the 70s, peaking with interest rates in the early 80s because of Volcker, now declining for the last 40 years, and now the third sea change is occurring based on the factors we just talked about a little bit earlier today. We wrote a newsletter about 3 years ago about returns. So a number of organizations, including some very impressive ones, Vanguard, JP Morgan, BlackRock, took a look at what they thought 3 years ago the returns for stocks and bonds were going to be for the next 10 years. And when we adjust their expectations back then for inflation and fees and put it together as a single portfolio, their expected rate of return was 1.3% a year. And I thought, wow, that's just a very, very aggressive low number. Well, let's take a look. It's 3 years later. So far, the results have been 1.9% per year for the last 3 years under Morningstar. But if I adjust for inflation and fees, it's minus 3 to 4% a year for the first 3 years of this 10-year projection. So there's more than a decent chance that that's going to be the number. So where do we add value? In commercial real estate with industrial and residential, with repositioning assets, special situations, and especially on build to own, creating assets from scratch. In fixed income, private assets, mortgages and private debt, and floating rate debt as well. And in public and private, we want to directly manage assets, and we have always wanted to focus on value and cash flow approach. All right, just before I leave, I just want to leave you with these 3 tools. So we're going to do some podcasts and webinars during the year with a deeper dive into all of this stuff. But these are 3 of the tools, and David was referring to the planning approach, that we think are critical for our clients. One was on compensation analysis, which allows us to tell clients when they should take dividends versus salary, the impact of the active business tax rate, when both make sense, when to use things like IPPs, individual pension plans, versus RSPs. On estate planning and philanthropy, what's the tax impact on income and asset building? What's the timing and structure of philanthropic gifts? How would you do these? The projections as to estate growth and foundations and donor-advised funds, and the tax liabilities that people have in their estates, and how they can mitigate them. And finally, the tax analysis of an investment. How efficient are your taxable accounts? is it better to do investing corporately or personally? And how do you use insurance, debt management, philanthropy to reduce taxable income? So what we want you to understand is that we have built a tool that will allow you to get your planning right first, and then take a look at the strategic approach that you want to take with your investment management. So with that, let me pass it over to my colleagues. This is for Ben. Please.
Thanks, John. So how were the markets last year? In one word, terrible. For a traditional 60-40 portfolio, it was the fourth worst year since 1926. Fourth worst in almost 100 years. Now, as John mentioned, our returns, our historical track record is quite strong. I'm talking about the markets here. If we take a look at the past 20 years, the 60-40 benchmark has had quite strong returns. Again, last year, terrible. Second only to the great financial crisis. In 2020, there was $18 trillion of negative yielding debt. 18 trillion. That means in Europe, if you bought a GIC, the bank didn't pay you interest, you paid the bank interest. You guaranteed yourself a loss. There was $18 trillion that were positioned to have guaranteed losses. Today, there's effectively zero. This evening, I'm going to review with you in more detail what happened last year, what we expect going forward, and finally, how we're positioned, the most important piece. How are we positioned to protect your capital? How are we positioned to enhance returns? Last year, it was all about inflation. We started the year at 7%, and despite central banks aggressively raising interest rates, we ended the year basically at 7%. The target for central banks? 2. This year, it's about a game of chicken. You see, the market is playing a game of chicken with the Fed. The market believes that the Fed will aggressively cut interest rates by the end of this year, whereas the Fed has said that they won't. Who's going to swerve? That's a critical question. And who swerves first will be crucial to investment outcomes going forward. Why does the market believe that the central banks are going to aggressively cut interest rates? This is Jerome Powell, the head of the Federal Reserve. You see, when inflation was going higher, he said, it's all transitory, don't worry about it. And yet inflation moved even higher, and he said, everything's fine. It's working the way we expect it to. And yet inflation moved even higher. And then he said, it's coming in higher than we expected. And then finally, he said, we're not expecting near-term progress on inflation. So at the beginning of the year, he said, it's all transitory. And at the end, inflation was on a rocket ship. And basically, they were saying, Houston, we have a problem. Now, we believe that the central banks are likely to keep rates higher for longer. If we take a look at the 1970s, we saw twin peaks of inflation. More recently, we followed this trend. And yes, inflation has started to roll over, but it took 2 years in the 1970s for inflation to normalize. And despite that, it still spiked. Now, we're not saying that inflation is going to spike again. We are saying that the central banks are concerned about it. It's weighing in the back of their mind. So likely, they're going to err on the side of caution and keep rates higher for longer. Now, what does this mean for your investments? When interest rates were effectively zero, investment-grade bonds were paying you 2%, high-yield bonds were paying you 4%, and preferred shares were paying you 5%. The yield on high-yield bonds wasn't actually that high. Since then, since interest rates have gone significantly higher, investment-grade bonds are paying you 5 to 6%, and high-yield bonds are paying you 8 to 9%. Fixed income yields are attractive. That's a good news story. Now, where specifically in fixed income do we like? As John alluded to, the yield curve is inverted. That means 20-year government bonds are paying you a lower yield than 2-year bonds. We're focused on shorter duration fixed income. We're focused in high credit quality names, safe names, less volatile, and it still pays you a higher yield. Now, what about equities? For equities, it's all about cash. You see, we believe that earnings are likely to be revised lower, but we don't envision a massive correction in the equity markets. Corporate balance sheets are quite strong. 60% of institutional investors are underweight equities and overweight cash and overweight fixed income. Generally speaking, when we see large corrections in the equity market, it's because of crowding. Something happens and people rush for the exit, and that stampede is what causes a lot of pain. We are not seeing that crowded positioning in equity markets today. Where do we see opportunities in equities? When we take a look at value versus growth. In the late 90s, there were these mega cap names that had leadership in the S&P 500. These were high growth names and they did extremely well. But then they rolled over. And for a number of years, value outperformed growth. We are seeing a similar situation today. When we take a look at value, we marry that by taking a look at high-quality names. Names that, generally speaking, have high free cash flow, that are not over-indebted. Oftentimes, these names are high dividend payers. Now, yes, we believe that earnings will likely be revised lower, and that would mean higher volatility in the public markets. When we take a look at volatility in the public markets as measured by VIX, the returns of the S&P 500 are a bit more muted, both during times of above average volatility and rising volatility. When we take a look at dividend growers and dividend payers, they've significantly outperformed the overall market. So we like dividend growers, we like dividend payers, we like high quality names at reasonable valuations. We also like real estate. REITs are trading at a 20% discount to NAV. In fact, industrial REITs are trading at a 10% to 15% discount. This volatility has created an opportunity for us to take a look at high quality names that we like and buy them at a discount. When we take a look at the world and we take a look at international equities versus US equities, the valuations for US equities have started to roll over, yes. But when we compare that to international equities, the dispersion or difference between valuations remains quite high. In fact, European equities are actually cheaper in every sector. When we take a look at US stocks, out of the 11 GIC sectors and take a look at their valuation, farther away from the center is more expensive, closer to the center is cheaper. And then we compare that to Europe. Every single one of the 11 GIC sectors in Europe is actually cheaper than the US market. So, bonds are back. We are seeing 5 to 6% yields in investment-grade bonds. 8 to 9% yields in high-yield bonds, attractive yields that we haven't seen for quite some time. That being said, we believe it's prudent to remain diversified. We are defensively positioned in our equity portfolios. And that allows us to turn volatility into opportunity. That allows us to buy REITs when they come to us at a discount. We're focused on dividend payers. We're focused on high-quality names at reasonable valuations. There are a lot of tools in our toolbox to protect your capital, enhance returns, and find alpha. Thank you. With that, Bijal, our CFO and head of Nicola Private Capital, will present next.
Thank you. I've never seen you so big as on the screen. It's my pleasure to come here and talk to you about private capital and give you an update on what we see as the market for 2023. Let's begin with some of the key events from 2022 first. Of course, we had the beginning of the war in the Ukraine. We had consumers dealing with inflation and the daily battles with that. We had billionaires being, well, billionaires. We had the continued impact from climate change around the world. We had stock market volatility, which you've heard about. And of course, we had the infamous slap. So with all of that noise in the system, what do you think about when you want to invest in private capital? It reminds me of a pair of scissors. When I first picked up a pair of scissors, my parents told me, this is a great tool, but you need to be thoughtful about how you use it. Private capital is the same way. It's a great tool for every investment portfolio, but you need to be thoughtful about how you allocate money to it. And the way to do that and generate alpha, 3 things to remember. Number 1, pick great partners who have long-term track records. Number 2, lean in on active management. Find companies where value creation is available. And number 3, portfolio construction. Diversification is your friend here. No big bets on any individual holdings. So with that, alternatives are becoming an increasing part of the investing landscape. If you look back at 2005, they were about 10% of the total picture. Now they're 17%. That's an increase in mix of 70%. And the forecast calls that to continue to grow, 19% by 2026, with AUM growth of 9% per year. So why are investors flocking to this space? Well, as you can imagine, it always starts with returns. If you look at 3 big buckets in private capital, equity, credit, and infrastructure, the blue bars are the private market returns, and the green bars are the public market indices. You can see these enhanced returns, and then they also come with historically less volatility, less ups and down movement month to month, quarter to quarter in pricing. So a smoother ride. And now we have the emergence of retail investors. They've been on the sidelines for a long time. As David showed, institutional investors have been investing in this space for a long period of time. Often 30 to 50% of their portfolio allocation is dedicated to real assets and infrastructure and private equity and debt. Now you've got the retail investors who've been typically 1 to 2% coming in with product innovation, greater awareness about the enhanced returns and lower volatility. They're now feeding a new demand into private capital. So now I'll walk you through some of the big categories of private capital, starting with private equity. So why do people invest in private equity? Well, you get access to more companies. In the United States, only 1% of all companies are on a listed exchange. And even if you take the bigger companies with 500 employees or more, still only 15% are on a listed exchange. So if you want access to greater diversification, more companies with growth prospects, you need to dig into that 85% that are only available in private markets. Active value-adding ownership. Historically, private equity firms have been able to go in and purchase companies at a lower multiple than the average on the index. And once they acquire them, they've been able to drive higher revenue growth and higher profit growth than the average on the index. What that leads to, of course, is higher risk-adjusted returns. So what's the big theme in private equity for 2023? It's going to be valuations. They're going to be under pressure. The days of easy credit, hot stock markets is over for a while. The good news is, during these periods where there is valuation pressure, it often leads to great buying opportunities. So if you look at some of the past periods of Gulf War, the dot-com bubble, global financial crisis, and COVID, you can see during each of these periods, private equity demonstrated very strong returns on an absolute basis and a relative basis to the index. So buying opportunity. Now let's turn to infrastructure. You've got transportation, energy, data farms, social infrastructure. What do all of these industries have in common? They're essential services needed on a day-to-day basis. They often come with contracts that have escalators in them in case inflation kicks in. They're with safe counterparties like governments, and they have low competition due to high barriers to entry. So investors in infrastructure have been benefiting from inflation protection, predictable cash flows, and low volatility. Now, I know a lot of you here think it's the year of the rabbit. Maybe some of you think it's the year of the balloon. I'm here to tell you, no, it's the year for infrastructure. In this exact current macroeconomic environment, this is when infrastructure thrives. You've got low growth, probably for the next several years. You've got high inflation, definitely for this year. And in this type of environment, infrastructure historically outperforms all other asset classes, whether it's real estate, equities, or fixed income. In addition to that, you've got tailwinds from massive government commitments around the world on energy security and carbon reduction. Over $4 trillion a year will need to be spent to meet these commitments. And then you've got digitization. I know this is important because I've got 2 daughters. And their preferred approach to communicating with me is by text, even if I'm in the same room, sitting right beside them. The only time they'll pick up the phone and call me, and when they do, it sounds like this. Hello? Dad, Wi-Fi down, Wi-Fi down. The need for information exchange, when it gets interrupted for consumers, for business people, it's chaos. So new investments in digitization will continue, and that'll fuel more growth in infrastructure assets. So let's turn to private debt and mortgages. Why do people invest here? Historically stable income. As John alluded to, floating rates in mortgages and private debt. So if inflation kicks in, coupons for the yield also go up. Downside protection. If you look at the left-hand capital stack of a company, if a company gets into trouble, the first people to get paid are the secured debt holders and the senior debt holders. That's where private debt and mortgages play. And of course, lower volatility, which we've talked about. So what are some of the themes for 2023? No other asset class is benefiting more from rising rates than private debt and mortgages. Yields are going to be strong. If I stood here a year ago, I would have said yields are probably going to be around 6 to 7%. Now I'm saying 10 to 12%. In addition to that, banks are doing what banks always do when markets are disruptive. They're pulling back and allowing private lenders to move in. And covenants are stronger. LTVs are lower. It's safer. So if you look at this picture, it's like Disney World for these people in private lending. They've got higher pricing, more demand, and less risk. They're getting equity-like returns, but holding debt. Now, of course, it is debt, so the one thing to watch are defaults. The default story hasn't been spelled out yet. It's going to depend on, do we have a recession? Yes or no? And if we have one, how long or deep might it be? So now let's turn inward a little bit and talk about our competitive advantage and what we see as different to the rest of the landscape. Remember the scissors. You need to be thoughtful about how you invest in here, picking great partners and good diversification. So the first factor that we believe is different, is we have scale. We have one of the largest private capital platforms in Canada at $3 billion across all of the key asset categories you would want: equity, venture, debt, mortgages, and infrastructure. We have a team of 20 and growing who actively monitor the portfolio on a day-to-day basis. Number 2, products. We break down traditional barriers to private capital. That's a great bumper sticker, but what does it mean? It means typically if you wanted to invest in private capital, you'd have to come forward with a large dollar deposit, maybe $1 million, maybe more. You wouldn't be able to ask for the money back for 10 years, maybe longer, and you'd have a limited set of diversified companies in there. With Nicola Private Capital, it's low minimum to get into each of our investment pools. You get ongoing liquidity, the right to redeem, and across our pools, broad diversification. So the bottom line, focus on long-term value always. Yes, there's going to be pressure on equity valuations, but also perhaps a great buying opportunity. Rising rates are helping fixed income the most, and infrastructure truly does have the wind at its back. And with that, I'd like to turn it over to Mark Hanna.
Thank you, Bijal. I am the last round of speed dating, as David would say. My name is Mark Hanna. I'm with the real estate group at Nicola Wealth, and I have the privilege of working with an amazing real estate team, and we have a lot of fun. I was sitting there in the audience, and I was looking at this picture, and I just want to put everybody's mind at ease that our real estate team doesn't burn money. That's not my dog, and those houses are not in our portfolio. We just finished completing our real estate webinar. We do this every 6 months, and it's about an hour long. It includes John Nicola giving a great economic overview, and then it's followed by a conversation with Mark Renzoni of our investment committee, along with my partner Alex Messina, myself, talking about the many topics of real estate. So I encourage you to go there. It's at realestate.nicolawealth.com. I don't have an hour to talk today. I'm sure you're relieved. I have a much shorter period. So I'm going to talk about 3 topics today. I'm going to talk about our real estate returns. I'm going to talk about what has changed in our strategy in the last 5 years. And then I'm going to talk about, in keeping with finding alpha, what are the investment themes we are pursuing going forward. Just a bit of a highlight here. Our real estate group is $9.6 billion when you include Blackwood. We have 324 properties, 19 million square feet. And last year, we acquired $1 billion in acquisitions. You can see on the left some of the acquisitions, and then on the right, the projects under construction, and then, of course, some of the leasing. Last year was a busy year for us. As I said, we did $1 billion in acquisitions, and in comparison to the year before in 2021, which is definitely the high water mark, we did $2 billion. So why was it less last year? Well, as interest rates went up, we definitely erred on the side of caution, and we started slowing down and to watch the market. But we still did 50 transactions in 2022. Our team completed 230 lease transactions, totaling 1.8 million square feet, and we have 4 million square feet in development with comprised over 20 projects. And we, in the self-storage sector, which I'll talk about shortly, we're adding 1,106 units in the portfolio. So let me talk about the 3 real estate funds. And I like to use these to show the history of the fund. So starting with the Canadian Income Fund, this was started in 2006. Well, that was the first full year. And you can see the returns for each year. So since inception, the average return is 9.8%. The return in 2022 was 13.2%. If you look at the outliers, the underperformers were 2008. Well, that was the mortgage debacle. And then, of course, 2020, that was the year of COVID. On the flip side, the outperformer was 2021. Why did that happen? It's because we made a big bet on the Ontario market and the industrial, and that paid off in terms of property appreciation and income growth. Moving to the U.S. Income Fund, that was established in partway through 2010. The return since inception is 11.8%. The return last year was 22.7%. Pretty consistent. Obviously, the outlier is last year, and the reason for that is the significant income growth in our multifamily portfolio and industrial assets. And then finally, our third fund, the Value Add Fund, it's a merchant fund. It works on both sides of the borders. It was established in 2015. The return since inception is 14.6%, and last year was 19.6%. So the reason I like to use these slides is to illustrate how consistent and resilient that all our 3 funds are. Okay, shifting to what has changed over the last 5 years. We've learned a lot. We're always tweaking what we do, and we're watching markets. We learned a lot during COVID. So in the Canadian fund, what happened? So industrial, it's gone up. We like that product type. We see that continuing to grow. Development, it was only 5%. Now we're 17%. We feel comfortable in that 15 to 20% range. Office, it's come down significantly. There's been a lot in the papers about people not going back to work, empty office towers. We still like certain types of office, but just not the big office towers that are very capital intensive. Self-storage, love self-storage. It was 11, and it's now 12, and it's only because it hasn't gone up significantly, even though we've added assets. That's because the fund has grown. Right now, we have 8 self-storage. I'd like to see us at 25 of those assets in the next 3 to 5 years. Multifamily, it was amazing. 5 years ago, we had 0% in our Canadian income fund. Now we have 10, and that's soon to be 20 once the projects in the development pipeline shift over to completed projects. Seniors housing, we like that asset class too. It's performed very well. It's 7%, it was, and now it's 4%. We didn't sell any assets. It's just that the fund got bigger, and we haven't added any more. We will look at that category as we go forward, but that's not something that we see in the near future. Retail went from 9 to 4. We did sell a few assets. We're not big on the retail category, but we still like having that within the portfolio. In terms of geography, BC, it's our home base. It went from 44 to 52. We love BC. It's expensive, but it's worth it. It's Vancouver, Kelowna, Victoria, Nanaimo. Those are strong markets for us. Ontario, same. It was 14% 5 years ago. Now it's 31%. I can see that growing to 40% or higher. Alberta, a lot of people were concerned that we had too much exposure in Alberta. Well, it's gone down. It's gone from 27 to 10, partly because we sold some assets above our NAV, and also because the fund has just grown and we have chosen not to concentrate on that market. Shifting to the US fund, multifamily, it was 58, it's 52. We didn't sell assets, it's just that the fund got bigger, and we've been focusing on the next category, which is industrial. We made a big push to get more industrial product in the US market to mirror what we've done in Canada, and it's paying off for us. Office, it's gone from 27 to 15, and we don't see the office category going up any higher than 15. Development, we had 0 5 years ago, and now we got 5%. I can see that growing up to the 10 to 15% category. And finally, retail, it's very small. It's similar to Canada. We don't see that category growing within that fund. In terms of geography, we've got good exposure in a lot of the right-to-work states, the friendly tax states in the US. So obviously Texas, Washington, Georgia. We haven't been selling assets. The only reason they're going down is because we've been building up our position in Florida, Minneapolis, Nevada, and Arizona. Okay, team, look at that picture of great people. I do have the pleasure of working with this group. We have 65 people. I can't put all 65 pictures on here, but I wanted to show you that the different areas of expertise. So we have asset management, development, finance, insurance, leasing, legal, mortgages, investments, and we have our self-storage team. So real estate does not run on its own. You need people that are passionate and to get these great outcomes for our clients, and that's what this team does. We also have great partners, and I haven't put their names on the slide, and I'm not going to mention the names because I'll probably forget a few of the names and I'll get in trouble, but we couldn't grow to our size if we didn't have great partners, and there's many of them in the audience here tonight. Okay, now I'm going to shift to in terms of our go-forward strategy. What are the themes that we're pursuing? So multifamily is very big. We like this asset class. It's very safe. I'm going to show you, this is in Canada, the James at Harbour Towers, and we did convert this and stripped it down to the concrete and converted it from a hotel back to an apartment building. In Canada, we can't, it's very difficult for us to buy apartment buildings, existing apartment buildings, so we find that we have to build them to get the returns that work for our funds. So that's how it works in Canada. But in the US, we are able to buy existing, and with our partner Venterra, we have 78 properties, 21,000 units, and we are able to acquire those assets at prices that work for our fund and get significant income growth. We are looking at building in that market down there, but right now the prices are more attractive to buy existing. Moving on to industrial, there's 3 distinct categories in industrial that we're pursuing. There's the mid-bay, there is the iOS sites, and then there's the small bay. So starting with the mid-bay. This is an asset that we have in Toronto. It's 300,000 feet, and it's leased to Amazon. It's brand new, it's in Mississauga. We had 4 tenants, full building tenants who wanted to rent it. We were patient, we got Amazon, long-term lease. The reason I like this is it's simple distribution space. If Amazon ever left at the end of the term, we would not have a problem leasing it up in that location, and we can lease it to 1 tenant or multiple tenants. Here's a similar building. I was just down in Vegas, looking at our properties down in Vegas and Phoenix. This is a building that's just finished. Same thing. We designed it so that you could split it into 4, but we ended up getting an offer for the entire building. We're just finalizing that lease at lease rates better than we perform it. IOS. What's IOS? It's an industrial outside storage. And this is my favorite one. It's in Las Vegas. And these are typically located in an infill location, usually embedded within a very established industrial node with other newer buildings in the area. The reason I like this is these tenants are getting squeezed. They have no place to go. And it's typically 10 to 20 acre sites. It's gated, it's paved. You might have a wash bay, a little office building, and then you have a lot of land area for their vehicles and storage. But what I do like about this asset class is that if you look in the bottom left, every time we buy a site, immediately we design what the building could be in the future. And so if one day we decide, if that tenant leaves and we decide it's time to build a new building, we can then proceed with the plans in place to build traditional distribution space. And then the last of the industrial category is small bay. This was one that we bought in Toronto a year ago. These were all small tenants, 3,000 to 6,000 feet. They were significantly under market, and our team has already rolled over 85% of these tenants to market, creating a significant income growth for our fund. An offshoot of this, and I didn't have a picture of this, is in our value add fund, we have a small bay strata, and one of the brands here is Interurban, and it does very well. And we sell those units. They're typically 3,000 feet, and it's very popular. We've done about 18 of these projects, and we very much like that in the value add fund. Self-storage. When we bought this self-storage portfolio originally, we bought 4 originally back in 2005. It's a simple business. People will pay $500 a month to store $300 worth of junk. I love it. I shouldn't tell you that in case you're going to go rent a locker, right? But it's a great business, and the key is to have a good management team, because it is an operating business, and we are very fortunate to have an awesome team in place that inspires the people on the front line. And this is a picture of one in Squamish. We had an existing building that had 880 lockers, and we're building a sister building right next to it. It'll be finished shortly, so we'll have a great position in that market. And we have 8, and as I said, I'd love to get to 25 of these, either in BC and Ontario. Covered land play. This word is used a lot. This is probably one of the best covered land plays we've done. We bought this property about 1.5 years ago. And if you go to Seattle, it's when you're going down the I-5 towards downtown Seattle, going to Seahawks game, you will see on the left-hand side the Northgate Shopping Center. But what's really cool is that Seattle has just finally put in their rapid transit system. So the transit station is right there, like right across the street. So we have these 3 office buildings, which our team's done an amazing job getting the income up on these assets. But meanwhile, the reason we did buy this site is because if you look in the bottom left, we can build 8 multifamily rental apartment buildings for 2 million square feet. So we're in the process of getting that zoning approved so that we can eventually redevelop this site down the road. Okay, last slide. Creative office. And for those of you in Vancouver here, Mount Pleasant is a really cool, popular area. So as I said, we don't like the high-rise office towers because they're very capital intensive, but what we do like is these smaller single-story or 3 to 4-story office buildings. So this is one that's just finishing at 5th and Columbia. And there's a lot of demand from these smaller tenants. Some are tech, some are other professional users. So we very much like this category, and we're going to continue to pursue it in this market and others. So with that, that's the end of my presentation. Thank you for your attention. I'm going to turn it back over to David Sung.
Thanks, Mark.
Yeah, thanks.
Thank you, Mark, and thank you, John and Ben and Bijal, for each sharing your insightful perspectives for 2023. Thank you for sharing a few nuggets on where you see us helping our clients find some alpha for the year ahead. This concludes our formal remarks and presentation for the evening, and I want to thank all of you for taking the time to come and join us tonight. So here's the suggested plan. Oh, here we go. Here's the suggested plan as we go forward. For those of you who are interested in participating in our question and answer period, we're going to take a 5-minute break just so that we can quickly set up the stage. So 5 minutes, stretch your legs, come back, and we're going to get going right away. For those of you who have had enough of Finding Alpha this evening, our bar and our hors d'oeuvres will be set up, and we look forward to joining you out there after the Q&A. Thank you very much, everybody.